Delving into Banking's Labyrinth, the Diverse Landscape of Service Fees by Pooyan Ghamari. The financial behemoths we recognize as banks are often synonymous with interest rates. However, to truly grasp their intricate revenue models, one must journey beyond the realm of interest into the diversified and vast expanse of service fees. A basic understanding of service fees. At its core, service fees can be seen as compensation for the myriad of services banks render to their patrons. While some fees are direct, transparent, and straightforward, others might be embedded in services or triggered by specific actions or thresholds. From essentials to elaborations, the spectrum of fees. Essential services. Every banking institution offers foundational services like account maintenance, check processing, and electronic transfers. While some banks waive fees for these essential services based on minimum balance requirements or monthly transaction volumes, others might charge nominal fees. Specialized financial services. Banks, particularly the larger ones, provide specialized financial advisory services. These can encompass wealth management, investment advice, or even retirement planning. Given the expertise required, these services often come with a higher fee structure. Foreign transactions and exchange services. With globalization, the need for foreign currency conversions and international transactions has surged. Banks often levy fees for these services, either as a fixed amount or a percentage of the transaction. Overdraft and credit services. When an account holder withdraws more than their available balance, banks provide an overdraft facility for which they charge fees. Similarly, credit services, like cash advances from credit cards, come with their own set of charges. Ancillary services. Think of services like issuing a bank statement, providing a checkbook, or even renting a safe deposit box. These might seem peripheral but are essential for many patrons and often have associated fees. Influences of fee structures. Several determinants influence how and why banks structure their fees. Operational costs. The complexity or effort required by the bank to render a service often dictates its fee. For instance, specialized advisory services require expert personnel, justifying higher fees. Market competition. In a fiercely competitive market, banks might reduce or waive off certain fees to attract and retain customers. Regulatory environment. In many jurisdictions, regulatory bodies impose limits or guidelines on certain fees to protect consumer interests. The significance of fees in banking revenue. While interest-derived income remains pivotal, fees play an indispensable role in diversifying a bank's revenue streams. They not only bolster profitability but also allow banks to subsidize other essential services, ensuring a comprehensive and enriched banking experience for their patrons. In essence, the universe of banking fees, with its breadth and depth, mirrors the multifaceted nature of modern banking. They're not just revenue drivers but also reflect the evolving dynamics of consumer needs and financial innovations.